But I just think that this is a market that's broken right now. The silver market is broken at the moment. We'll see how it all plays out, but this is a game where I think the desire to take paper promises is disappearing, and the world is saying we want the real thing, and that's putting some major stress in the marketplace. And the players who are trying desperately to not let the price go away from them by selling futures have created a massive, massive backwardation that, I mean, I've never seen anything even close to it. So in other words, you know, you want to sell something right now, the bid price right now, let me look and see. Right now, spot price is 52.08 or thereabouts, but the futures price right now is $50.56. So it's coming back a bit. It was almost $3. Now it's like $2.50. Or let's see, 50.56 minus what? 52.08. So it's at $1.60. It's coming back a bit, but your bid price would be based upon 50.56 as the futures price. Yet if you're buying, you're paying on 52.08 ask price. I have never seen anything like that. And I would say to people that this will change. This will, the spot and the futures price will get more in line. But what it really means is that this is not a seller's market at this point. Hold tight. Wait till this rectifies itself. But I could see a massive spike in the spot price as you see margin calls and the fallout from global margin calls where big players have to, you know, the lease rate used to be 0.5%. Now it's over 100%. So if you need to get metal to cover a position or to short, well, you're paying 100% premium. That doesn't work. The market is broken, and it could very quickly put some big players underwater very, very, very quickly. We've been talking about the bleed down in the London inventories, and as a result, we're seeing massive backwardation, and it's rare in silver. It signals urgent demand, and it signals depleted inventories. It signals a systemic shortage of deliverable bars and a liquidity collapse. We've seen a $3 premium to New York futures, a spread that hasn't been seen since 1980 during the Hunt Brothers squeeze, and a borrowing stress cost where in order to borrow silver, a lease rate, it's called, it spiked above 100% annualized. That's worse than the 1980 panic. No one's ever seen anything like that. A lease rate that is normally 1% or less is now over 100%. This is putting some of these short traders in a very, very dangerous, precarious, and quite frankly, frightening position. And, you know, I don't know. This isn't even manipulation. This is firms liquidating positions due to financing costs and exploding volatility and illiquidity. This is something that I don't know if it doesn't get better anytime soon. I think fireworks will be the name of the game. Then again, I've never seen a market like this that has reacted as fast as this has. At the same time, I don't know that I've ever seen a market where gold goes up over $100 in a day and silver's moving up 3% and 4% in a day. Oh, they can do that. They might be right. I don't think they are. You know, be leery of the guy who says this time is different, but it feels different. The physical supply just isn't there right now. And now you're seeing margin stress hitting the paper market. Margin calls are going to start going out. This means that all these leveraged players are under massive pressure. This is a hallmark of illiquidity and forced liquidations. I think that the only way to smooth out the uncertainty of should I wait or should I not is to cost average. Because one of these days, as we've been saying for a long time, the wolf cometh. You know, me, you, the little boy who's cried wolf on the front page of the book. At the last chapter, the wolf comes. And is this the wolf coming? I don't know. It feels like it. And this is a problem when the currency that we call The dollar feels more like a melting ice cube than it does a store of value. And I think the world sees that. And there is a real push to get the real thing instead of rolling over futures contracts. And I really want to hammer it home that this is the big noise about shipping silver to London isn't strength. It's a cover story to calm nerves. If supply were fine, there wouldn't need to be a PR push that we're seeing right now. I don't know. This tells me it's just getting going. Yeah, I mean, you're seeing no liquidity in the marketplace at all. I mean, really, you're seeing none. You're seeing a lot of the big players are sitting on the sidelines. And, I think that what you have in essence is that the shorts are not really able to deliver. And that's the problem. There's a lot of shorts who don't want to deliver or can't deliver. And if that happens, it's the longs. Everyone thinks the longs are the ones that initiate the delivery, but that's not what it is. It's the shorts who have to be able to deliver. And it's not the longs who control delivery. You can think of it like a coat check at a theater. The long is the person holding a ticket who wants their coat back, but the coat doesn't move until the attendant, the short, hands it over. And on Comex, it works the same way. If someone already has silver sitting in the vault, they can't just pull it out. First, they have to check it back in by becoming a short in the delivery month. And then they use their long position to stand for delivery, which triggers the metal to move. So while the longs have the right to take the silver, it's the shorts who actually make the process happen. And the bottom line is the sellers with physical silver in the system are the ones who control how and when metal is leaving Comex. And so when we see more shorts piling on right now, this is actually a very bullish thing for silver as far as I'm concerned. And so, we're talking stress in the Comex. We're talking stress in the LBMA. We're talking stress in the dealers who are frozen right now because in order to lock things in as a dealer, you're buying at spot, but in order to hedge your position, the futures markets in silver are as much as $2.5 or $3 back of spot. And so that's putting the dealers in a horrible position. A lot of them are freezing up. They don't want to play in this market. There is no liquidity in this market. So it's something that ultimately will hopefully resolve itself, but I've never seen a market quite like this. I've always told people, watch how fast this changes, where a couple of weeks ago you could buy Silver Eagles for under $4 an ounce. Now you're going to pay anywhere in America approaching $8 an ounce, and it's just beginning. So yeah, I think that there are pivot points everywhere. The LBMA, the Comex, the big wholesalers, the bullion banks, the big refiners. None of them want to do anything because the price is so far back on spot. I mean, on the futures market, so far back of spot that it's creating a near impossible environment to work on. Okay, this morning, this is from one of our very, very, very large Florida wholesalers. Good morning, dealers. Due to the current market conditions, especially in the silver market, we have temporarily halted all trading until we are able to get a handle on premiums this morning. This should be temporary and expect discounts to change on silver products. We will send out a new sheet as soon as we are able to. That's how real it is that major wholesalers are not able to get a handle not only on escalating premiums, but also upon the ability to hedge exposure. They did resume trading again, but this isn't just dealers. This is refiners. This is big wholesalers. This is the mints that they just cannot hedge their exposure in a market like this, and can very quickly grind things down to a halt. Not to mention, we're seeing the price move up at a level no one's ever seen. And then they knocked the snot out of it the other day, and what do you know? It's right back up. They knocked it down to 49. Now we're up to 52. They knocked it under 4,000, and now we're over 4,100. the demand for physical metal globally is outpacing the paper market for the first time ever. And this is what happens when the paper shorts get caught with their pants down. And the articles in Bloomberg and Reuters are in my opinion, BS. They're covering, they're laying down a little bit of rhetoric to cover and give them some time to get more metal. But no, I think things are about to get really interesting done again. I truly do. And I think if people are waiting for that big pullback, it's silly. I mean, it's showing strength that no one's ever seen before. So cost average your position instead of trying to bet that this time will be just like it's always been, because one of these days it won't be. And it just feels like we're already on that pathway right now.
Well, Andy, we're going to maybe not have to go a whole week before we do another update, because with things changing so fast, we might have to do another brief touch point later in the week. But we're grateful that you took time away on your getaway. So hopefully we can let you go now so you can get away.
Yeah, well, I'll be back on camera next Monday. I'm sorry about this. It's just I'm actually had to pop into a hotel in order to do this. We were on an excursion that took far longer than were promised, and I'm sorry. I'm just trying to pivot best I can to honor my word. I would always try and make this happen, Dunnigan. You know that. And sometimes it's easier than others. But if I'll leave people with any thought, it is simply that something's broken in the market. And what is broken is that there is a coordinated effort, I think, to prioritize physical delivery over paper promises. And it's real and it's happening. And people would be best to not wait for the pullback, but to cost average their position inward. And I think that is the most prudent way to attack the unknown.